overlapping. Okay, some of the functions are also overlapping, which means that sometimes finance can do what the accountants do, and sometimes finance can do what the economists do, right? But not everything, okay? Because nobody can be everything, okay? Right? Now, so from this diagram, you should be able to know that accounting is related to finance, finance is related to economy. Now let's see. So they are closely related and overlapping. Okay, in smaller firms, the financial manager generally do both functions. Okay, which are the function of the accountant and also the function of the financial manager in the smaller firm. But in the case of Malaysia, accountants do the both functions. Okay, because accountants are more in number in Malaysia than Malaysia. Right? Now, one major differences between finance and accounting is that I have mentioned to you before. Remember that I've given you a case study which state that accrual basis and cash basis. You remember? Okay. So one major difference is accounting emphasis on accruals. Okay, whereby accruals is actually you recognize the transaction as when it occurs. Correct. But finance focus on cash flow. It only recognizes when we really receive the cash, or if we really pay the cash, pay out the cash. Okay, so this is the major differences between accounting and finance. If you open page 12, in page 12 there is an example about Nassau Corporation. The Nassau Corporation, okay, stating that the Nassau Corporation, if it is in the accounting view, you will get a profit of 20,000 because it is on accrual basis. But if you look in the finance perspective, you will get only a negative 80,000, which is a negative cash flow. Right? When you get a negative cash flow, the perception of the public about the company is not good, right? Because when you are having a negative cash flow, actually, perception is that you won't be able to pay the employee's salary, the creditors, the suppliers, okay, the government, okay, by paying tax, because you have a negative cash flow. So how are you going to pay all of these suppliers, creditors, government, and etc. Right? So when this perception is being perceived to the company, automatically the company share prices will go down. So a negative cash flow is not preferable for a corporation. Okay? Right, now let's go to the next slide. I don't want to talk more about that because it's going to take a long time. We'll go one by one. Okay, and other thing is that finance and accounting also differs with respect to decision making. Okay, basically accounting did not involve a lot of decision making. Okay, because you are preparing the statement, you present the statement. Whereas finance, you will involve with making decisions. You analyze the financial statement, then you decide whether we want to invest, whether we want to acquire funds. That is your advantages from accounting majors. Okay, so I'm not saying accounting majors cannot decide, but the advantages of the financial manager that they can make decisions. Okay, they can make decisions. Okay, so what accountant is primarily concerned with the preparation and presentation of financial data. Okay, and the financial manager is primarily concerned with analyzing and interpreting this information, okay, for decision making purposes. Right? For example, if you want to invest, if Unitan want to invest in Badan Azam Shah, the financial manager will analyze the investment that we will do here, so whether we can get a good return or not. So after a lot of analysis, they will decide that okay, we can invest in Badan Azam Shah because we can get profit such as that. Okay, so that is the task of the financial managers. They have to decide. They have to give consultation to the management whether we can invest or whether we can finance such investment. Alright. Now let's go to the next slide. Okay, the goal, objective, or goals and objective of the corporation. Okay, if you look at the slide in front of you, you must have remember that you have learned this during contemporary business class. Okay, do you remember? Okay, the basic form of business organization. There are three major forms of business organization in Indonesia. Right? Number one is the sole proprietorship. Okay. Number two is the partnerships. Number three is the corporation or company. Right? So sole proprietorship is normally owned by individuals. Mostly it is owned by one individual. Ali, sole proprietorship, right? Abu, sole proprietorship. Akau, sole proprietorship. Partnership will be owned by two or more partners. Right? Corporation will be owned by the shareholders. Right? Sometimes corporation can become a public listed corporation. Sometimes it is only a private limited company. Okay. What we will focus on this semester is corporation. You can just avoid thinking about the sole proprietorship and also partnership. We will focus on corporation only. So now, what are the goals of the corporation? Will it be maximizing profit? Will it be maximizing profit? What is the goal of the corporation? Maximize profit. Maximize profit? Maximize profit. Okay. You have learned microeconomics, right? Have you? What is the goal of the corporation? You remember the whole semester you learn about profit maximization. Correct? Yes. Correct, right? So what is the formula for profit maximization? Sales minus with total cost. You get profit. Okay. So in terms of economy, the basic goal is profit maximization. But in finance, profit maximization is not necessarily the main goals of the corporation. Right? Okay. Why not? Why not? Because in finance, good answer. Because in finance, because we want to maximize the shareholder wealth. Okay, but maximize what you think it again? If we maximize our profit, will it maximize our shareholder wealth? Not really.
You got 20,000. If you feel the cash flow is still negative 80,000, position for your to stop for your company to go down. So you're not making the shareholders well.
Correct, good answer. Yes, correct. Well, profit alone does not really reflect the maximization of wealth to the shareholders, because it has neglected three elements. It neglected three elements, which are the timing of returns, okay, cash flows, and also risk. If you look back at the equation of profit, the equation is sales minus total cost. Okay, no timing of return, no cash flow, no risk inside the equation. Correct? But in finance, these three elements will be included. Okay, why is timing of return is really important in finance? Okay, open to page 14. There are two investment alternatives. Okay, Roto and VAR. Page 14. Roto and VAR. Okay. Now, I would like to pose this question. Which alternative that you will choose if you look at the investment? Roto or VAR? VAR. If VAR will give you a total earning per share of 3 ringgit, right? Roto will only give you a total earning per share of 2.8. So which one do you choose? Okay, who choose Roto? Please raise your hand. Who choose? I don't want you to read the book, okay? I just want you to just answer it without any knowledge about it. Okay. What will you choose? Roto or VAR? VAR. Because it gives you a higher earning per share. Okay, a total earning per share of 3 ringgit. Okay? The answer is VAR or Roto? You are hoping that it is going to be VAR. Okay, the answer is correctly. The answer is Roto. Okay, why do you choose VAR instead of Roto? EPS is higher. Okay, now if you look again at the example, okay, in year 1, Roto actually give you a return of $1.40, whereas VAR only give you a 60-cent return. In this case, if you use that 140 and then reinvest back again, then you can get a higher return sometimes. And also the timing of the cash flow, you get 140 now, it is better than you get 60 cents now. Right? Let's say, I'll give you one example. What's your name? Yes? Shen. Okay. Shanti. Right? You? No? Siti Nurhayati. Siti Nurhayati. Okay, let's say Siti Nurhayati and your name? Miss? Marshita. Okay. Let's say Siti Nurhayati want to sell her what do you call that? Not pencil box, pencil case, no, not case. Pencil bag. Okay, want to sell her pencil bag to Shanti. Okay, for 10 ringgit. Okay, Shanti is willing to buy it because it's so beautiful. Got the Doraemon, Pokemon picture, right? Okay, so Shanti says, I want to buy your pencil case for 10 ringgit, but I want to pay installment payment. So pay $1 each month, so 10 months. Okay, 10 months. But still you get 10 ringgit, right? And then Marshita came to Nur Hayati and said to her, I want to buy your pencil bag, pencil bag, and also I want to pay installment, but I will pay you 5 ringgit in the first month, then the other 5 ringgit in the next 5 months. So which one do you prefer? You want to sell it to Marshita or you want to sell it to Xingping? Marshita, because you get a 5 ringgit in the first month, right? So you don't have to collect $1. So the timing of return is actually important. So the earlier you get the return, it is better. And also you have to see the level of the return. Okay? In the first year you are getting 5 ringgit, and in the first month you are getting 5 ringgit from her. But if you sell to her, you are getting only 1 ringgit in the first month. Whereas the 5 ringgit that you get from her, you can buy other things, then you can sell to maybe, what's her name? Fahira. You buy the pencil, then sell it to Fahira. Then you can get more profit or more return after that. Okay? So, and also a higher earning per share. A higher earning per share does not constitute that you will get a higher share price. Okay? Now next slide. Next slide is the example. Okay? Here's the example from the textbook. Investment A or B, we stand for Roto or Buff. You must choose Roto. Okay, you must choose Roto. Okay, because profit maximization fails to account for the differences in the timing of this cash flow, the level of the cash flows as opposed to profits, and the risk of this cash flow. So there are 3 elements that profit maximization fails to account. Okay, level, timing of the cash flow, and also the risk of the cash flow. Now let's look at the next slide. So here is not the profit maximization. The goal of the corporation should be maximizing the shareholder wealth. Okay? And maximizing the shareholder's wealth is also the same as maximizing the firm's value or maximizing the share price. Because of when we maximize the share price, actually we are maximizing the shareholder wealth, because if you buy the share at 10 ringgit, okay, and then suddenly the share prices increase to 20 ringgit, what happened to your wealth? Your wealth increased by 10 ringgit, right? Okay, so when you are the stockholders, you want your share to increase. Okay, so the task of the financial managers is to increase the share price, and it will increase the shareholders' wealth. Slip of the tongue. Okay, now let's see what is the equation for share price. What's the formula for the share price? If you look at the formula will be future dividend divided by required return. And when you look at the components of the future dividend, actually it consists of level and timing of the cash flows. And when you look at the components of the required return, it actually involves risk of the cash flows. So there are 3 elements that the finance included in calculating the wealth maximization of the share. Whereas the profit maximization, it ignores and fails to account all of these items. Okay, continue to the next slide. So, how are we going to maximize the shareholders' wealth? Okay, we can use a formula which is called the economic value added. In short form, we call it EVA. Okay, EVA is a measure to determine whether the investment will increase the shareholder wealth or not. Okay, the formula is operating profit after tax minus cost of funds. Okay, since you have already gone through the accounting class last semester, you must have remember that during the course you are being required to prepare the financial statement, right? Do you remember that operating profit is actually profit after deducting all operating expenses? You get operating profit before tax, right? But in this case, you have to less tax also. So actually, it is actually operating profit after tax. Then you have to less in the cost of funds. Okay, the cost of funds are actually the cost of you acquiring the funds. Okay, for example, you lend from the banks. What is the cost from the banks? Okay, you issue the share to the public. What is the cost to you? So this is called cost of funds. And EVA is actually the same as net present value. Okay, it's the same concept. Okay, but we call it differently. Net present value is being commonly used nowadays. Okay, net present value. So a positive EVA is preferable because it will increase the shareholders' value. Okay, a negative EVA, it will decrease the shareholders' value, because if you look, if it is a negative EVA, it is surely a negative profit. Actually a loss, right? Okay, but if it is a positive, it is showing you that it is a positive profit. Okay, any questions? So in this case, financial managers will always make decisions. Okay, decisions which will lead to an increase to the share prices. Okay, if the decision does not lead to an increase of the share prices, they will reject the alternative, or they will not do or implement the decision. Okay, I will show you with a simple diagram. This is the financial manager. It has an alternative, two alternatives, A or B. Okay, and then he will ask what is the return to the investment, what is the risk associated to the investment, and will it increase the share price? Okay, this is the question that he will ask himself. Okay, if the share price is increased, then he will accept the alternative of investment. If it does not increase the share price, he will reject it. Very simple. If it increases the share price, you accept the investment. If it does not increase the share price, you reject the investment. Or in other words, if it gives you a positive NPV,